The market sell-off continues. On Friday, we've had a red day, and it does seem like right now on Monday, we're having a red day as well. Although, as you can see, there are plenty of companies in maybe not the tech industry or maybe not in the AI team that are clearly in the green right now. So if you did not ask any questions as to why your stock went up so much year to date or in the last couple of months, you probably shouldn't be asking questions right now when those stocks are taking a hit, right? If your stock is up already 50, 70, 100% year to date or 300% in the last 3 months, then you shouldn't be surprised if your stock is now down 10% or 15% in a week. This just wasn't that sustainable. Now, is this a buy the dip opportunity or are we going down even more? Well, to be honest, I don't know. Nobody knows, right? Nobody has a crystal ball. We could rebound tomorrow. We could go down even further tomorrow. The most important thing here is that, well, as Warren Buffett said, a true investor welcomes volatility. At the time of making this video, this is the current state of the stock market on Monday. So yes, the market sell-off continues. We had one on Friday and it does seem like Monday, plenty of stocks are down as well. But as you can see, plenty of stocks are also in the green. Now, I'm sorry to say this, but when you look at a lot of stocks that are down right now, 10%, 15% in the last week or so, you zoom out a tiny bit, you see that those stocks are still up year to date, 20, 30, sometimes even 50%. And then if you zoom out a little bit more, in the last 3 months alone, these stocks might be up 100%. So plenty of folks are not asking any questions when stocks go up, right? Nobody really asks questions when stock goes up. But when the stock suddenly goes down, we're like, oh, wait a second, hold up. Wait a minute, why is my stock down? Well, why is your stock down? You should have asked the same question before. Why was your stock up 50%? Did something change with the business? If the answer is no, then you should ask the same question right now. If my stock is down, did something change with the business? If the answer is no, then who cares? Maybe your stock was just too expensive for the market. Eventually, there is a rebalancing coming, right, for every single stock out there. If nothing changes for the business, what you're getting right now is the same company, but for cheaper. And I think most investors would welcome that. I'd also like to react to Tom Lee's comments from last week.
As investors grow more concerned about a slowing economy, the Dow and S&P 500 turning in their worst session of the year so far. And joining us now is Tom Lee from Fundstrat Global Advisors. He's also a CNBC contributor. And Tom, it is great to have you on a day like today where the major averages are not only lower on the day, they're lower on the week. And the Dow, the S&P, and the NASDAQ are now also lower for the month of February so far. We teased it ahead of this conversation, the fact that you're seeing a contrarian bullish signal here. What is it?
Well, it's a couple things, but I'd say what really stands out to us is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very skeptical of these new highs. That bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved higher, too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Before he answers that question, and by the way, his answer here blew my mind because all of these surveys and all of that are extremely manipulated and should not really be taken that seriously, especially if you don't know what he said. If you didn't watch this video already, your mind might be blown as well. But remember, Tom Lee at the end of 2024 said that the first half of 2025 is probably going to be a good first half of the year for the stock market, and the second half is expected to be weaker. Because, well, the market might be looking at, okay, is Doge actually working? What about AI growth? What about economic growth? are all these things actually doing what they should be doing? Is everything going according to plan? Yes or no? And maybe in the second half, things will get a little bit more rocky, more uncertainties, etc., etc. Of course, you could say the same thing about the market right now, about sentiment right now, right? Tariffs, Doge, earnings, AI demand, whatever, could also be impacting the first half. Now, let's continue with the answer here.
Well, these inflation expectation surveys matter to the Fed because they're concerned about whether or not consumers are actually raising their inflation expectations, and that would, in fact, be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
I don't know about you, but when I hear these types of things, I just can't take these surveys seriously anymore, and hopefully the Fed has much better data coming their way. If we're quickly looking at the Fed Watch tool, the next Fed meeting is in 23 days. We can see that, well, no rate cuts are expected, right? There is a 95+% chance that we are staying at the current rates. And so quickly looking at the stocks that we follow, the biggest stock that is down right now, it's Palantir, it's down 8%. We've got Shopify, Uber, Celsius all down above 2%, but we have also a couple of green ones. Expedia, Apple, after their announcements that, well, they're going to invest $500 billion in the United States in the next couple of years. We have Google Alphabet that is also green. I believe they just won a contract for Google Cloud from Salesforce, so that's great. Disney up a little bit. The Trade Desk, after getting hit quite a lot after their last earnings report, which by the way was the first miss in 8 years. Still not the cheapest stock out there, but this one is up 1%. And then we've got Lemonade, which is up 1.74%. Looking at Chinese stocks, Alibaba is actually down 9.43% today. Alibaba was also a little bit overbought. The stock went up already 60% or so year to date. So a terrific performer even after this hit. I believe also on Monday they announced that they're going to invest quite heavily in, well, the data center, AI and all of that. I believe over $50 billion or so. I guess the market doesn't like that. Me as an investor, I think this is a necessary step. We've seen that with the American companies, right? CapEx, huge investments, and I think that's a positive thing. Pinduoduo is also down 8%, so Chinese names are taking a bigger hit as of right now. Looking at some fintech names, we see that Affirm and Robinhood are down 4 to 5%, SoFi down 2.7%, Block down another 2.68%, Adyen and Shift4 are basically flat-ish. Same with PayPal, although in the green, and then Nu. Out of all of them, Nu, after getting hit 18% last week after the earnings report, it's actually up 5.13%. And then quickly looking at the semiconductor stocks, as you can see, most of them are red other than Applied Materials and ASML. All the rest are red, and SMCI, well, tomorrow on a Tuesday, the deadline for the company, they have to file, and if they don't, then, well, delisted yet again. So this is the current state of the semiconductors. And then the last one, those are basically a list of short-term bets or extremely volatile stocks that got a lot of momentum. So Viking Therapeutics down 11% today. I believe Friday there were some rumors that Pfizer might acquire the company for $40 to $50 or so. So stock went up and now we're back down. Then we have Nebius that is also down 8%. The quantum computer players, etc., all the other space players are also down quite heavily on the day. What is green is Transmedics, up 3.86%, dLocal up 1%, IonQ basically up 0.5%. So it does seem like dLocal, Mercado Libre, Nubank, new holdings, should I say, those are green as of right now. So Latin American names do get some love when, well, the rest is quite red. For those that are interested in Nike, Jeffries came out and said now is the time to aggressively buy Nike. Nike's brand remains strong and strategic missteps allowing competitors to gain market share was not fatal for the sportswear giant, leading Jeffries Randall Koenig to upgrade the stock to a buy from hold with a 53% hike to its price target. Said the following: the new CEO is tackling product and distribution issues head-on, positioning the brand to again outgrow the market and take back lost share. Koenig said in a note to his clients, adding that he expects a V-shaped margin EPS recovery in fiscal 27, well ahead of the consensus estimates. If you haven't followed the earnings reports or earnings calls, Nike CEO said that the recovery is going to take longer than expected. You might say, okay, but he's the new incoming CEO, has plenty of experience with Nike, he's probably putting the bar quite low, so it makes his life, his job a little bit easier. Yes, I could agree with that. With a brand like Nike, again, it's an iconic brand worldwide, but I do think that if you want to regain that super leadership position, all of that, I do think it's going to take longer than expected. This is not a software issue. No, this is, well, I wouldn't say a branding issue, although some might say yes. It might be a product issue. The analyst continued by saying Nike's brand ubiquity and global distribution advantage should allow it to outgrow the market. We project an around 7% CAGR versus 3% for the street, pointing to market data that shows more than 50% of consumer planning to buy athletic footwear will choose Nike. After a few years of challenges and self-inflicting wounds, we believe new leadership will improve product direction and re-establish balance between DTC and wholesale. We believe now is the right time to aggressively buy shares, seeing more than 50% upside from the current levels. And if we go and look at where Nike is trading at right now, just above $80. If we look at the year-to-date performance, currently up 6.67%. And so to conclude, if you see that one of your stocks that you own is down heavily today, zoom out a little bit and check if that stock isn't up 50%, 30% already year to date, and you might understand why it's taking a breather. Plus, if your stock isn't up that much year to date or in the last couple of months, and the business is still doing well, if it already reported earnings, and that was fine or to your liking, you like the commentary, etc., you just got a good deal, right? Volatility should be your friend. Sometimes there are overreactions, and again, we don't know, we cannot time the bottom, we don't know unless you have a crystal ball to sell me. I'll pay you a lot of money to get access to that. But when I see a company that I like that is trading at a good price, the market is red, fine. Much better to buy when the market is red than when the market is green. And so for the next time, if you're panicking, like my community post said on Friday, you can either do nothing or you can buy more shares of good companies that are down a lot because the market is down because of macro reasons. And 3, sometimes the best thing to do is just go out, take some fresh air, go for a walk, forget about the stock market because, let's be honest, there are better things to do anyway. So all in all, that's about it. Am I buying anything today? No, I did some buying already on Friday. If you missed that video, that will be in the top right corner, portfolio overview. As of right now, I don't see this as a major crash or something like that that would force me to add even more aggressively. I'm still building up my position in AMD, so I'll probably be adding if it stays under $110. If it goes closer to $100, I'll probably continue to add that. But other than that, nothing really. So hopefully this is a helpful video calming down the nerves. If you did buy something, sell something, let me know down in the comment section below. Like, subscribe, all of that, and I'll see you all in the next one. Bye-bye.